In this video, we'll showcase the top 5 reports every business owner should know. These reports will help you track your financial performance, identify trends, and make informed decisions about your business. So let's get stuck in. At number 5 is the Bank Reconciliation Report. This report helps you check what's recorded in your accounting records, accurately reflects what's in your bank account, and it helps you identify and resolve any differences. The report typically includes a list of all outstanding checks and deposits that aren't yet reflected in your bank statement, as well as other transactions that need to be reconciled. Once these items have been accounted for, the report should show that the company's accounting records and its bank statement agree. It's a really useful report, and I recommend you run it at least once a month, if not more often. At number 4 is the Aged Receivables Report. This report helps you manage what's owed to your business and helps you get paid on time. It shows invoices that haven't been paid yet and any that are overdue. The report ages what's due to your business, so you can quickly see what's been due for less than a month, 2 months, or longer. Remember, cash is king. Getting money into your business is what keeps you in business. Review this report regularly so you can take action to collect payments from your customers, such as by sending reminders or making some phone calls. For cash businesses that don't need to create sales invoices, a simple income by contact report can be useful, as it helps you see your most important customers. Coming in at number 3 is the balance sheet. This is important because it provides a snapshot of the financial health of your business. It shows what you own, such as assets, cash, and inventory. And it shows what you owe, such as loans and amounts due to suppliers. If you're applying for a loan or looking to sell your company, the balance sheet will be one of the first things to get scrutinized. At number 2 is the Statement of Cash Flows. This report shows how well your business can generate cash and how it's using that cash. It can also help you spot any potential cash flow problems. And remember, cash is king. There are 3 main sections: operating, investing, and financing activities. The operating activities section shows the money coming in and going out from your main business activities, such as buying and selling goods. In this section, you want to see money coming in. After all, these are your main business activities. Investing activities shows money paid or received for investments in or disposals of long-term assets, such as property, plant, and equipment. A cash outflow in this section isn't necessarily a bad thing. If you're investing in new equipment, it may mean that your business will be better placed to make profits and therefore generate cash in the future. The financing activities section shows money received or paid for borrowing or repaying debt. A cash inflow to take out a new loan may seem bad, but if it's to invest in the future of the company, it may be a good thing. So don't just look to see if there's cash coming in or out here, look at the reason for the movement. Overall, the Statement of Cash Flows is a valuable tool for understanding a company's cash flow and making informed financial decisions. And the number 1 report you need to know is the Profit and Loss or Income Statement. The report shows how your business has performed in a particular period. It shows your income and expenses and calculates total profit. At the top, you have your sales, and then what it costs to generate those sales, things like purchases and other sales-related costs. The gross profit or gross margin is sales less cost of sales. This is an important figure because it shows how profitable your core business operations are, before taking into account overheads or taxes. It's a useful indicator of a company's efficiency and competitiveness, and it can be used to compare the profitability of different companies or industries. For example, if a company has a gross profit of 30%, it means that it's making 30 cents of profit for every dollar of revenue it generates. A higher gross profit margin generally indicates that a company is more efficient and profitable. After deducting overheads, such as rent, salaries, utilities, and other costs, we arrive at the net profit. This is your bottom line because it shows the overall profitability of your business. A company with a consistently high profit margin is generally considered to be well managed and financially successful. The profit and loss is great not just at seeing if you've made a profit, but also to help you spot trends over time and identify areas of your business that you might need to work on. If this video was useful, give it a like or let me know in the comments if there's another report you think should be on the list. Thanks for watching.